Welcome to the Deep Dive. Our mission today, well, it's pretty clear. We're looking at what seems like a real regime change in the digital asset markets.
Yeah, it feels different this time.
We've got this rare mix of things happening, a big tactical price breakout, a huge supply risk vanishing, and all these global institutional stories bubbling up. It feels like more than just market noise, right? Like a real realignment.
Exactly. The last 24 hours really confirmed a shift, From playing defense to going on offense, the market's posture has definitely changed. Gone from just bouncing around in a range to a clear bullish trend.
Okay, let's unpack this.
And the key is the timing. You had this major de-risking event, the Mt. Gox delay, happen right when the market made a key technical jump. So we're here to walk you through how that breakout worked, why that Mt. Gox ghost is fading, and these new structural drivers from Europe and Asia.
Okay, let's zero in on the price action first. It's pretty aggressive, broad-based too. Bitcoin's trading strongly, around $115,291. That's a gain of, what, over 3.8% pretty quickly?
Right. And it wasn't isolated. It caught a wave of global risk-on sentiment. The catalyst seemed to be the news that President Trump's latest tariff threats against China were, well, off the table.
Ah, okay. So that gave markets globally a bit of breathing room.
Yeah, a sigh of relief. And capital just flowed into riskier assets, including Bitcoin.
And technically, that move was significant.
Oh, hugely significant. Crucially, the price broke through and actually held above that major resistance level we talked about, $113,500. When you see a breakout like that stick, the whole market structure flips instantly.
So what was resistance becomes support?
Precisely. That level, $113,500, it's now the critical pivot. It's the immediate support line. As long as we stay above it, the move looks solid.
Okay, charts are one thing, but what about the network itself? Does the on-chain data, back this up? Is it real conviction or just retail getting excited?
That's the crucial question. And what's fascinating here is, the network data absolutely confirms the structural change. The price didn't just break chart resistance. It pushed above the short-term holder cost basis.
Which was right around $113,000, was it?
Exactly. And that's as much a behavioral indicator as a number.
Explain that significance for us. Crossing the short-term holder cost basis. What does that really mean?
Okay, think of it like this. That STH cost basis. It's basically the average price paid for every coin bought in, say, the last 5 months or so. Recent buyers. When the price is below that line, most of those recent buyers are underwater. They're losing money.
So they're nervous, maybe looking to sell if it gets back to where they bought in?
Exactly. They represent potential selling pressure, sort of an overhead supply. By pushing back above $113,000, you've basically put that whole group back into profit. That immediately takes a huge chunk of potential selling off the table. It flips that on-chain resistance into on-chain support. It shows conviction is building.
Okay, that sounds healthier internally. But the rally was fast. You always worry about leverage, right? Was this just driven by derivatives, by speculation? Makes you skeptical about how long it can last?
It's a great question. High leverage is usually the first warning sign, isn't it? But looking at the derivatives market, the momentum actually seems pretty healthy. Perpetual futures funding rates, they're neutral, barely positive, actually, hovering around 0.000096%.
So not those crazy high rates we sometimes see before a crash.
Exactly. We're not seeing those superheated rates like 0.015% or higher that scream, too much leverage, corruption coming. However, the data really points towards spot-driven demand.
Meaning actual cash buyers, not just futures bets.
Right. People accumulating the actual asset. That neutrality in derivatives suggests there's still room for more upside before things get overheated.
Okay, that gives us some confidence in the rally's immediate health. Let's shift gears now. Let's talk about that huge supply risk that's haunted the market for years. Mt. Gox. Here's where it gets really interesting.
Yeah, the Mt. Gox saga. It's basically been the biggest known forward supply risk hanging over the market. And the news is the repayment deadline for about 200,000 BTC, that's billions of dollars worth, has been pushed back again.
By how much this time?
A full year. It was October 31st, 2025. Now it's October 31st, 2026.
Wow. 200,000 Bitcoin. The scale is just massive. That's way more than gets mined in a day.
Oh, yeah. More than 10 times the daily production. It's huge.
So, okay, great news short term. But doesn't just pushing a giant potential sell-off down the road just mean a bigger problem later in 2026? What's the catch?
That's the critical way to frame it, absolutely. And Purely procedurally, yeah, you could say it's just kicking the can down the road.
Yeah.
But the market impact is now. It removes that imminent supply risk that big players were actively pricing in.
So institutions were holding back a bit, maybe, expecting this supply dump?
You have to assume so. When you've got something that large on the calendar, it naturally puts a damper on things. Everyone's bracing for a potential liquidation event. Pushing it back gives the market 12 months of clear runway without that specific risk factor hanging over it. And the second thing is the pattern. This is the second year in a row they've postponed it.
Right. Starts to feel less like an imminent shock.
Exactly. It suggests the whole process is way slower, more bureaucratic than people initially feared. It shifts the expectation from a sudden crash to maybe a long, slow, managed distribution way down the line.
These repeated delays. It almost suggests the trustee is, well, aware of the market impact, acting cautiously.
This really does raise an important question about maturity, doesn't it? I mean, a trustee's job is fiduciary. They need to maximize the return for creditors. If they just dumped 200,000 BTC and crashed the price, they wouldn't be doing their job very well.
True. Crashing the asset defeats the purpose of distributing it.
So this cautious approach, even if it's just procedural delays, it kind of signals that these state-level bodies, legal entities, they're learning how to interact with the Bitcoin market as a financial ecosystem, not just like it's some pile of seized goods to be auctioned off quickly. Managing it, stabilizing it, reducing that state-level liquidation risk, that's a fundamentally positive signal for the long term.
Okay, so the supply side looks less scary for now. Let's pivot hard to demand, specifically Europe and Asia, where we're seeing some real structural adoption happening.
Yeah, definitely some positive tailwinds building. Starting in Europe, you've got the regulatory gears turning on the big UCITS framework.
UCITS made. That's the Undertakings for Collective Investment in Transferable Securities, right? Governs huge amounts of retail funds.
Trillions of euros worth across the whole EU. It's massive. And the European Commission confirmed they're starting consultations in 2026 to update the rules.
Trillions is. Yeah, that's arguably the biggest pool of professional investment capital outside the U.S. Why are these consultations such a big deal? What's changing?
The key detail comes from ESMA, the European Securities and Markets Authority. They're proposing to allow indirect crypto exposure within a fund's 10% portfolio allowance.
The 10% allowance, isn't that sometimes called a trash ratio? Like for slightly riskier or less standard assets?
Chuckles lightly. Yeah, that's the informal term. It gives managers flexibility for assets that don't meet the super strict main criteria, but are still only a small part of the overall fund.
So this gives fund managers the regulatory green light to buy things like Bitcoin ETFs or other crypto derivatives.
Exactly. And even though it's capped at 10%, the UCITS market is so enormous. If managers allocate just, say, 1% of that total capital.
We're talking potentially hundreds of billions of euros flowing into regulated digital asset products.
Precisely. It creates this foundational, compliant demand channel, something that just hasn't been available to most conservative European retail investors before. This feels like a structural shift, not just a temporary trend.
Okay, from Europe to Asia. Japan just hit a major milestone, right? G7 level stuff.
Yeah, Japan, famously a very cash-heavy economy. They just launched JPYC. It's their first fully regulated yen-pegged stablecoin, and it's backed one-to-one by actual domestic savings and Japanese government bonds. This is huge because it creates a fully compliant bridge between the yen and the blockchain.
An official on-ramp and off-ramp. And is this just some small fintech thing, or does it have backing from the big players?
No, this signals a deep institutional shift. It's so properly regulated and backed that Japan's 3 massive megabanks, the incumbents, are reportedly now scrambling to issue their own stablecoins.
Because they see the writing on the wall.
Absolutely. They realize if they don't offer a compliant digital yen, they'll lose business to newer players. It's the legacy system embracing regulated digital currency infrastructure in a major G7 economy.
And then briefly back in the U.S., the political talk seems to be changing too.
Yeah, it's interesting. Donald Trump's informal comment suggesting crypto could somehow help with the $35 trillion national debt. Now, obviously, there's no policy behind it right now. But just the fact that it's being mentioned, it reframes the asset in that high-level political conversation.
Moves it from just speculation to maybe a tool of sovereign finance.
Sort of. Regardless of your politics, when presidential candidates start talking about Bitcoin not just as, an investment, but potentially as a strategic reserve or a debt tool, it just normalizes the whole idea of governments and major institutions interacting with it seriously.
Okay, shifting to the corporate side, the infrastructure.
Yeah.
We keep seeing BlackRock just steadily buying, right? reinforcing that institutional demand.
Yeah, that $225 million deposit this week is just another example. Their IBIT ETF is getting closer and closer to $100 billion in assets under management.
That's just huge, steady, regulated buying, week in, week out.
That flow is definitely validating the demand. But let's look where that capital meets the actual infrastructure, because that's where a really interesting re-rating is happening. There's major drama with that proposed $9 billion takeover of Core Scientific by CoreWeave.
Right, the Bitcoin miner. What's the drama?
The big proxy advisory firm, ISS, just told shareholders to vote against the deal. The vote's coming up fast, October 30th.
Wow. Why kill a $9 billion deal? Price not good enough.
It's purely about valuation, yeah. But the reason is the key structural insight here. ISS argues the deal undervalues Core Scientific's energy and infrastructure assets, especially given the massive demand from AI.
So it's not just about Bitcoin mining anymore. It's about power and data centers for AI.
Exactly. This is fundamentally changing how the market looks at Bitcoin miners. They're not just valued based on the Bitcoin price anymore. They're being re-rated as proxies for energy, for computational power infrastructure.
So shareholders are thinking, hey, this data center mining Bitcoin, maybe its best use is actually serving AI because that market pays a premium for power and compute.
Precisely. It starts to decouple the value of the infrastructure from the daily swings in Bitcoin price. It creates a sort of valuation floor for these quality mining operations, regardless of crypto volatility. This whole AI Bitcoin convergence thing, where Bitcoin mining, this huge energy network, is now seen as potential bedrock infrastructure for AI. That's a massive strategic shift to watch.
That's a powerful convergence. Are there other tech developments supporting this?
Yeah, we're seeing sort of two tracks of adoption building at the same time. We talked about the regulated institutional path, like JPYC in Japan. But then there's the permissionless technological side. Look at Coinbase's Payments MCP, that's Model Context Protocol.
Payments MCP, that's about machines paying machines, right? AI agents.
Exactly. It's infrastructure to give AI agents, LLMs, other software, their own on-chain financial tools. The big vision is agentic commerce, where machines just transact directly with each other using stablecoins. They're even planning to revive that old unused web code, 402 payment required.
Okay, that's pretty technical. Give us a simple example. What does that actually look like?
Okay, imagine your smart home AI needs a super specific answer from some specialized AI server farm. Instead of bugging you for payment approval, the agent just gets that 402 payment required signal, and boom, it autonomously pays the server, say, 5 cents in stablecoins right on the blockchain. Microtransaction complete.
And the regulated stuff like JPYC provides the trustworthy stablecoins for these systems to use.
Exactly. The institutional legitimacy builds the foundation for these cutting-edge, machine-driven uses to actually work reliably.
And while this AI layer is building, Bitcoin itself is evolving beyond just being digital gold, isn't it? Layer 2s are growing.
Absolutely. The Layer 2 ecosystem is expanding fast. Networks like Stacks, Rootstock, Merlin Chain, their total value locked is climbing. These networks bring smart contracts, DeFi, all secured by Bitcoin's main chain. It transforms Bitcoin from just a store of value into a programmable financial base layer.
Okay, one last thing quickly, market consolidation. Seeing some smaller players shut down.
Yeah, that's often a sign of maturity, actually. The shutdowns of Paxful and BunnyDX show a real flight to quality. Paxful cited compliance costs from past issues. BunnyDX basically ran out of money for crucial security audits after getting hit by an $8.4 million exploit.
So the costs of running securely and meeting regulations are getting higher.
Right. It's becoming a barrier to entry. It favors the larger, better capitalized, heavily audited platforms. Less room for the smaller, potentially riskier players. Hashtag tag outro.
So what does this all mean? We've covered a lot of ground technicals, Ment Gox, AI infrastructure.
Yeah, putting it all together, for the tactical trader, you've got to stay watchful. Keep an eye on that short-term resistance around $116,000 and the new support floor at $113,500. And remember, we've got potential volatility triggers coming up. The Fed's rate decision on the 29th, that Core Scientific vote on the 30th. Keep watching those funding rates, too. Make sure things don't get too frothy.
But for the longer-term view?
For the long-term strategic investor, the picture definitely looks stronger. The Mt. Gox cloud lifting is significant. The UCITS progress in Europe, the JPYC launch in Japan. These are real structural tailwinds. It really reinforces that idea that the market is maturing. You know, it's not done, but it's growing up. So any short-term dips, well, they might look more like opportunities if you believe in that long-term structural story.
Okay, final thought then. The thread connecting all this seems to be normalization, right? from data centers to maybe even sovereign debt chat. So here's something for you to chew on. If the market's already re-rating mining infrastructure based on AI's hunger for power and compute, how quickly will the traditional energy and finance sector stop seeing Bitcoin miners as just crypto companies and start seeing them as essential providers of dispatchable energy and critical computing infrastructure? That could change the whole valuation game and the political debate around energy almost overnight.